अब बस 2 मिनट में स्टार्ट करते हैं सर. द पीपल आर शेयरिंग, मतलब पीपल आर ज्वाइनिंग. वी हैव शेयर्ड द लिंक टू ऑल. 2 मिनट में स्टार्ट करते
मेरी एक पीपीटी है तो वो
हैं
मैं
आप.
शेयर कर लूंगा।
हाँ, वो आप शेयर कर लेंगे. फर्स्ट आई विल गिव द इंट्रोडक्शंस एंड देन आई विल हैंड ओवर द सेशन टू यू. एंड देन
श्योर।
ठीक है.
ओके।
स्क्रीन पर ले आइए. स्टार्ट करें सर.
यस, एब्सोल्युटली।
ठीक है सर. सो आज का हमारा टॉपिक इनकम टैक्स के ऊपर है. देन आई गिव द ब्रीफ इंट्रोडक्शन अबाउट द सर. सर हमारे प्लेटफॉर्म पर पहली बार इनवाइट हुए हैं, पहली बार आए हैं. तो इट्स ए वेरी ग्रेट प्लेजर फॉर अस to have the deliberation of the Rohan sir. Let me give the introduction. Rohan Sogani is a chartered accountant and is a law graduate. Has more than 12 years of experience in the area of the direct tax and foreign exchange management act. He has also in the past worked for EY and PwC. He regularly appear before the appellate forums in the field of the direct taxes such as Commissioner Appeal, IT80, and has many reported cases to his credit. Very nice. In the past, he has written an article which has been published by the Chamber of Tax Consultant, Mumbai, Tax Sutra, Taxman, ITAT Online. He has been a speaker in various seminar and study circular meeting of the various branches of the ICAI. With this brief profile, मैं सर को रिक्वेस्ट करूंगा कि सर काइंडली स्टार्ट द डेलिब्रेशन, द टेक्निकल डेलिब्रेशन. ओवर टू यू सर.
Thank you, Arunji. Thank you, team Educating, for inviting me in today's webinar. And I would straight away jump onto the topic without wasting much time into the topic proper. I would just share my screen. I have a PPT made with respect to the topic which I would be covering. Now, today's topic is my screen visible?
विजिबल सर.
So, today's topic, which I would be covering, is the direct tax issues. Whatever issues are in relation to the provisions which are contained in the Income Tax Act in relation to the business restructuring which is done. Now, business restructuring is a very wide topic, and it can involve a lot of transactional level business restructuring. For example, business restructuring would involve two companies merging into each other, one company demerging and creating a separate entity out of its own entity, Business restructuring also involves slump sale. It also involves specific transactional level or asset wise sale. Then there are other restructuring aspects also, like internal restructuring of the company, converting one type of capital into another type of capital, or maybe converting the entire company into another entity. For example, converting the entire company into a limited liability partnership firm, or maybe converting a firm into a company. So there are lots and lots of areas where business restructuring happens and which have implications under the Income Tax Act. We would not be able to, in a short span of 2 hours, we would not be able to cover all the topics. So what I have done is I have selected few specific areas which in our day-to-day working is relevant for each one of us. Of course, there are other areas also which I may not be able to cover right now because of the paucity of time, but there are other issues also which one needs to consider. For today's topic, we would be specifically focusing on these issues because what I feel is that if we talk of these issues specifically in detail, then I think the purpose of this webinar would be to an extent served. Regarding the topics which I would be covering the tax implication because I would be specifically dealing with the direct tax provisions, or one can say the provisions which are contained in the Income Tax Act in relation to conversion of a company into LLP. So there are a lot of transactions which happen these days wherein there is a company. Now the company is wanting to get itself converted into LLP. We would be discussing in detail. Then conversion of a partnership firm into a company. There is an existing partnership firm which has been going on for years. Now they want to scale up their operations, or maybe in times to come, they want to list their entity. So they would have to pass on the journey from a partnership firm into a company, and then thereafter further journey. So what would be the implication of converting a partnership firm into a company? Then we would be covering about the reconstitution of the partnership firm. It so happens that a lot of in these days, lot of partnership firms get into reconstitution, wherein partners change their partnership ratios. Some of the partners retire from the partnership firm. New partners are introduced into the partnership firm. So we would be covering for certain aspects of reconstitution of partnership firm. Then we would be covering conversion of securities because under Companies Act there are a lot of securities which can be issued, such as equity shares, such as preference shares. These days, convertible preference shares are issued, which can be converted from preference shares into equity shares. These days, a lot of companies are issuing convertible debentures, compulsorily convertible debentures. Now, what would be the tax implication once these debentures are converted into equity shares? What would be the tax implication at the time of their first issuance, and thereafter what will be the implication at the time when they are converted into another security or another type of security under the Companies Act? So we would be covering that. Then lastly, we would be covering buyback of shares by a private limited company, because most of the private limited companies these days, what we encounter is they want to change their shareholding pattern. Some of the companies want to distribute certain profits to their shareholders, but the dividend distribution mechanism is quite costly for them. So we would be discussing about buyback of shares by private limited companies. Now, let us take each and every topic specifically. First is about conversion of a company into LLP. Now, when I talk about converting a company into LLP, before that, one should understand what is a company and what is a LLP. LLP means limited liability partnership firm. Now, this is some sort of a presentation wherein a company has been compared with a limited liability partnership firm. Now, as we all know that the governing act is the Companies Act 2013. In case of a LLP, the governing act is the Limited Liability Partnership Act 2008. Now, the charter which is there is, we all know, it is Memorandum of Association, Articles of Association. In case of a limited liability partnership firm, there is a partnership agreement which is entered, which defines a lot of things, because we will be discussing going forward that why would anyone want to convert its company into LLP. So one aspect is to provide a lot of flexibility in terms of the operations, which in a smaller scale is not available in case of a company. So, a limited liability partnership agreement determines a lot of contractual inter se relationship between the partners. Then, in case of a company, there are minimum two members, maximum 200 members can be there in case of a private company. In case of a LLP, there has to be two partners, maximum, there is no limit. Then, in case of a company, there are board meetings which are held, and in case of LLP, there is no statutory requirement in terms of holding a meeting. However, one can incorporate certain such aspects in the partnership agreement, and it would be then governed by whatever is written and agreed upon by the partners. And then compliances, we all know in today's day and age, there are a lot of compliances which happen in case of a company. There are a lot of forms which are to be filed with the registrar of companies. There are a lot of penalties which are levied in case there are delays, or the company does not file certain forms. So there are higher compliance burden which is involved in case of a company, and it also entails a lot of penalties in case of non-compliance and delayed compliance. In case of an LLP, of course, if we talk about a simple partnership firm in comparison to that, there are relatively compliances which are to be done. However, if we compare it with a company, with a private limited company or a limited company, in terms of compliance, there are relatively lower compliances which are required to be done. Uh, in last 3 4 years, there is also a requirement of mandatory spending of corporate social responsibility in case of a company, but there is no such requirement of a CSR liability in case of a limited liability partnership firm. Then related party transactions, of course, depending on what the company is, what is the size of the company, there are restrictions on related party transactions which are there. However, there are no such restrictions in case of a limited liability partnership firm. Now we come to the important thing, why one of the main things why a company normally gets converted into LLP, the tax rates which are involved. Now, if we look at the base rate, the corporate rate, the corporate tax rate for a company, it is approximately 25% the base rate, and there is also 115 BAA, which is available, where the base rate comes to around 22% with the maximum rate of 25.17%. In case of a newly incorporated company which is engaged in business of manufacturing, then the tax rate is around 17.16%, 15% plus education cess and surcharge. However, if we look at a limited liability partnership firm, the tax rate are still quite higher, and the base rate is 30%. So effectively, if we look at a company and a limited liability partnership firm, if we compare the rates of these two entities, so there is mostly a difference of around 8% in the base rate. The limited liability partnership firm being taxed at the rate of 30% base rate, and company being taxed normally under 115 BAA at the rate of 22%. So here there is a lot of difference between a company and an LLP. Then one important difference between the two is how the profits are distributed uh, to the shareholders in case of a company and to the partners in case of a limited liability partnership firm. If we talk about the company, there is the profits can be distributed by way of declaration of dividend. Now, declaration of dividend has its own cost because nowadays, after the abolition of the DDT, dividend distribution tax, the dividends are taxed in the hands of the recipient shareholders at the rate at which they are taxed at as in their normal income. So whatever dividend, so there are two levels of taxation which takes place in case of a company. One is when the company earns profit. At the profit earning level, the company has to pay tax of approximately say 22% base rate, and once the dividend are declared out of that profit, then the shareholders in their own hands have to again pay tax. So there is a two-tier taxation mechanism in case of a company. Now, the best part in case of a limited liability partnership firm, which encourages a lot of companies to convert themselves into LLP, is that there is once the profits are taxed at the LLP level, there is no further taxation which is there when this profit is distributed to the partners. So once the LLP pays tax at the rate of 30% on its profit, then subsequently, when such profits are distributed to the partners or the partners withdraw their capital, then there is no taxation in the hands of the partners, and whatever profits are distributed, these are exempt in the hands of the partners. So in case of a company, as we have already discussed, there is two-tier taxation which actually increases the tax burden, even though the corporate tax rate applicable on companies is quite less. But if we look at the entire scenario, then in case of a LLP, the tax rate is lower. Now, this would be we would be discussing going forward that this sort of setup maybe would be beneficial when more and more profits are to be taken out by the company and to be distributed to the shareholders. In that scenario, it would be better to go in for a LLP structure rather than a company structure. However, on the other hand, if the company wants to plow back its profits for more and more investments, and it has a game plan of making more and more investments, or probably it is in a sector which requires a lot of investments, then a company sort of a structure would be better, and there would should not be any need of converting that company into LLP. Now, as far as one more aspect is concerned, that is of deemed dividend. Deemed dividend is something which a lot of companies suffer with, because whenever loans and advances are given to the shareholders, in certain scenarios, it attracts deemed dividend. So in case of a company, there is taxability in the hands of the shareholders in terms of deemed dividend, but there is no such concept of deemed dividend in case of a limited liability partnership firm. So, as we've discussed, there are two main aspects which one needs to consider while converting a company into LLP is that at the profit at the taxation level, there are two-tier taxation system in case of a company. One is the profits being taxed at the company level, and thereafter, once the profits are distributed in the form of dividend, then again dividend distribution, whatever profits are distributed, dividend has to be taxed in the hands of the shareholders. However, in case of a limited liability partnership firm, once the taxation happens at the partnership firm level, thereafter there is no requirement for taxation. And there are freely transactions can be done between the partners in the LLP, whereas it is very difficult to do transactions with a company and a shareholder, because in case of a shareholder, if a loan is received by the shareholder, then it can attract deemed dividend, and there can be tax incidence on these transactions. Now, with this, we must first understand if we talk about converting a company into LLP. Now, before discussing on the income tax provisions, one needs to understand why would a company want to convert itself into a LLP. Now, there are a lot of factors, and this is quite specific to an entity based on whatever business it is doing, whatever compliance level it wants to have, whether it is having what all assets it is having with it, whether it wants to distribute profits going forward. So, all these factors are very important in determining or taking a decision whether to convert a company into a limited liability partnership firm. Now, we have had instances wherein suppose a company is there, the company has been in existence since long, and the company is having a land, because prior to introduction of 50 CA, I would be discussing about 50 CA. A lot of these transactions of purchase and sale of land used to happen through the company, wherein suppose the land was purchased by a company, and then for transfer of that land, the shares were transferred and not the underlying land. So a lot of instances are there wherein a company is having the only land in it, and now if the company wants to sell the land, so one of the most tax efficient manner would be to convert this particular company into LLP, because otherwise, if the company sells the land and thereafter it is not doing any business, then this profits which would get accumulated in the company would then have to be distributed to the shareholders. And again, as I discussed, there would be two-tier taxation. One at the time of sale of land, the company would suffer a long-term capital gains tax, whereas thereafter, once the profits are received into the company, then the profits would then be distributed to the shareholders. At that point of time also, there would be taxability in the hands of the shareholders. Against that, if one thinks of converting this company into a LLP, then there would only be one tier taxation, because once the company is converted into LLP and thereafter the land is sold, then in certain circumstances we would be discussing that the land would again be a long-term capital asset in the hands of the LLP, and there would be taxation only at the rate of 20%. And once the profits are accumulated into the converted LLP, then the partners can take out these profits without paying tax. So this way, lot of tax can be saved. However, I have been discussing about tax saving mechanisms. One also needs to bear in mind that now there are general anti avoidance rules which are known as GAR. Now, GAR we would not be discussing in detail because it itself is a very big topic. But in crux, it is that once any transaction is undertaken or any restructuring is done, the main motive of it is to avoid taxation. Then there can be GAR implications. And once I talk about GAR implication, the through by invoking of GAR, what income tax department can do is the income tax department can undo the entire transaction and can recover the tax as if the transaction would have been done through a proper channel. For example, if I talk about a company getting converted into LLP and thereafter the LLP selling the land and distributing profits to the partners, if the sole intention is to avoid tax, and if the tax department or invokes GAR in this particular transaction, then the income tax department have all the powers to ignore the conversion of a company into LLP and then to recover the entire tax as if the company would not have been converted, and the company would have sold the land and thereafter tax the distribution of dividend to the shareholder. So the GAR implications, the general anti-avoidance rules implications are also to be considered. So wherever there would be requirement in this particular session wherein I feel that GAR provisions would also play an important role, I would highlight that. But in case of a conversion from a company into LLP, one has to look at section 47 clause 13b. As we are aware that section 47 consists of those transactions under the head capital gains which are not regarded as transfer. As we all know, as per section 45 of the Income Tax Act, a capital gain arises in case of a transfer of asset takes place when a capital asset is transferred. However, Section 47 prescribes those transactions which will not be considered as transfers, meaning thereby that if a transaction is not considered as transfer, then it will not be taxable under the head capital gains. So there is a clause specifically when we talk about conversion of a company into LLP. This clause is clause 13b, which is contained in section 47, and which says that if certain conditions as specified therein, and we would be discussing about those conditions, if certain conditions are fulfilled, then when a company gets converted into a limited liability partnership firm, then there would not be any tax liability in the hands of the company or the newly formed LLP or even the shareholders in the company which is getting converted. So the entire transaction of converting the company into LLP would go without payment of any tax. So this is very, very important once we talk about conversion of a company into LLP. Now, what are the conditions which are required to be fulfilled? First condition, as you can see, is that all the assets and liabilities of the company immediately before the conversion should become the assets and liabilities of the limited liability partnership firm, meaning thereby that if suppose a company is being converted into an LLP today and whatever assets and liabilities are there with the company after the conversion into LLP, all the assets and liabilities held by the company on the date of conversion should become the assets and liabilities of the LLP. Normally, whenever any conversion takes place in the Companies Act and read with the Limited Liability Partnership Act, the entire assets and liabilities get vested from the company to an LLP. So in most of the conditions, most of the times, this particular condition gets fulfilled. So one need not worry that much about fulfilling these conditions. And mind you, whatever conditions we would be discussing, because there are mainly six conditions which are to be fulfilled. All these conditions have to be fulfilled cumulatively. If a particular conversion does not fulfill any one of the conditions, then it will not get covered under section 47(13)(b). And once it is not getting covered under section 47(13)(b), then it can have implications under the Income Tax Act, meaning thereby that this conversion can be a taxable event for the company and its shareholders. Now, the second condition which requires to be fulfilled is that all the shareholders of the company immediately after the conversion, before the conversion, become the partners of the limited liability partnership firm, and their capital contribution and profit sharing ratio should be the same, should be in the same proportion as their shareholding in the company as on the date of conversion. Now, this is very important because if suppose a company was having, say, three shareholders, A, B, and C, each having 33, 33, and 34% of shareholding, then the inter se shareholder percentage or the ratio of the shareholding should be the same once the company gets converted into LLP. Because once the company would get converted into a limited liability partnership firm, the erstwhile shareholders in the company would then become partners in the limited liability partnership firm. So the percentage or the proportional percentage should remain the same in case of an LLP. There should not be any change. Then third condition is that the shareholder of the company do not receive any consideration or benefit directly or indirectly in form other than by way of share or in profit and capital contribution, the limited liability partnership. Now, this is very important because if suppose suppose a company is getting converted into LLP, then if there are three shareholders and they have invested a particular sum in the company, then upon conversion to LLP, the entire sum should get transferred as part of their partnership capital. So there should not be anything extra which the shareholders should be receiving from at the time of conversion from the company or thereafter from the LLP. So the shareholders, the entire shareholding should then get converted into their capital contribution in the LLP. Now, the next condition is that the aggregate of the profit sharing ratio of the shareholders in the limited liability partnership shall not be less than 50% at any time during a period of 5 years from the date of conversion. This is another important condition which requires to be fulfilled, is that once a company is getting converted into LLP, then at least 50% of the shareholders should remain the same. So, for example, there are three shareholders A, B, and C. As we discussed, if the shareholding between them is 33, 33, and 34%, and upon conversion, they include one more partner into the LLP. Then in that case, they should ensure that the total shareholding of A, B, and C in totality should be at least 50%. If it goes below 50%, then this condition would not get fulfilled, and there can be issues as I mentioned earlier. Then the total sales turnover and gross receipts of the company in the 3 years preceding the previous year in which the conversion takes place should not exceed 60 lakh rupees, and the total value of the assets should not be more than 5 crore rupees. This is another important condition which needs to be fulfilled. whatever gross receipts are there of the company in the preceding 3 years, it should not be more than 60 lakh rupees. So this is essentially for those companies which are not working, or maybe they have not reached to a particular scale that they are into a lot of big operations. Those companies have been given an option to convert themselves. Of course, in today's world, when a turnover of 60 lakhs is nothing, so in times to come, probably we will see this turnover requirement being threshold being increasing. But as of now, this turnover requirement is just 60 lakh rupees. So if a company in the last three preceding years has turnover of less than 60 lakhs, then only this condition would be fulfilled. If in any of the years it is more than 60 lakhs, then this condition would not get fulfilled, and one would not be able to take the benefit of 47 clause 13b. At the same time, one will also have to look at the total value of the assets of the company. Assets means whatever assets the company is having, the book value of that asset should not be more than 5 crores. Now, here I specifically talked about the book value of asset because it has been specified in the section itself that the total value of the assets as contained in the books of accounts should not be more than 5 crore rupees. Now, there are a lot of confusion or controversies which happen because if suppose a company is having a land, now at the time of purchase of that land, the land was of say 1 crore rupees, but now today the market value of that land is say 100 crore rupees. Now the question arises whether one will have to look at the market value of that land, or one will have to look at the book value of that land. Now, if we look at the section itself, in that it specifically says that the total value of the assets as appearing in the books of accounts of the company. So my view is that one, if we look at the value of the land, one will have to look at the value of the land as contained in the books of accounts, and one will have to not consider the market value of that land. So meaning thereby that if suppose a particular land is of say 1 crore rupees in the books of accounts, and if the market value of land is say 100 crore rupees, then also one can think of converting that company into LLP, because one will not have to consider the market value of that particular land. Then no amount is paid directly or indirectly to the partners out of the balance of the accumulated profits standing in the accounts of the company on the date of conversion for a period of 3 years from the date of conversion. This is another important aspect which one needs to consider, because normally what happens is a lot of queries are received by us that we are having a lot of accumulated profits in the company. Now the company wants to distribute these profits. What if we convert this company into a limited liability partnership firm and distribute those profits? The answer is completely no, this is not possible. This can only be possible if the profits are distributed after 3 years from the date of conversion. So there is a lock-in period of 3 years which is provided in this particular clause, wherein if a company, if at all it is having accumulated profits and wants to convert itself, then those accumulated profits cannot be distributed to the partners in the converted LLP for a period of 3 years. And mind you, this 3 year period is to be seen from the date of conversion. So if suppose, and we will be discussing the next slide, that if suppose this conversion, if suppose one distributes the profit within 3 years, or the other conditions which are provided in the clause are not fulfilled, after the conversion, then in the year in which those conditions are not fulfilled, the taxability would then arise in that particular year. So, for example, if suppose in year one I convert the company into a LLP and it has accumulated profits of say 50 lakhs, and upon conversion immediately thereafter, say in year two, the LLP distributes these 50 lakhs to the partners. Then in year one, when the conversion upon conversion there was no taxability, then in year two, when the conditions which are prescribed in clause 13b, if they are not fulfilled, then it would result into taxability in year two. This is because there is a section which is provided. We will be discussing about that section, section 47A, which says that if the conditions are not fulfilled, then this 47A would then be applicable. Now, we have been discussing about conversion of a company into LLP. So, if suppose 4713B conditions are fulfilled, then there would not be any tax liability in the hands of the company. There will not be any capital gain. Even if there is a particular land which the company is holding or any stock in trade which is there, there would not be any capital gain in the hands of the company. Now, as far as the partners are, as far as the shareholders, which ultimately become the partners in the limited liability partnership firm, there would not be any capital gain in their hands as well. In their hand, and this is specifically provided in section 4713B. Now, as far as the LLP is concerned, the LLP would not have any tax implication under section 56 to 10 as well. And the only thing the LLP would be doing is that the block of asset would then be transferred to the LLP. And there is one requirement that the depreciation which is claimed under the Income Tax Act, the depreciation which is claimed in the company and thereafter in the LLP should be on a proportionate basis in as per the number of days which the assets are used by the company and the LLP. And the total depreciation which is claimed by the company and LLP should not exceed the amount as if the depreciation as if the conversion had not taken place. So this one needs to consider. As regards the the depreciation, if suppose a company is having accumulated losses and unabsorbed depreciation, then and if the conditions as prescribed under section 4713B are fulfilled, then in that case the depreciation, unabsorbed depreciation, accumulated losses are allowed to be carried forward into the converted LLP as well. So there is no restriction in terms of carry forward of accumulated losses and unabsorbed depreciation. We have already discussed if any of the conditions as prescribed under 4713B are not fulfilled. For example, the lock-in period of profit of 3 years distribution, then in that case, 47 capital A would get triggered. And if once the year in which the condition is not fulfilled, in that year, there would be deemed taxation, and whatever tax which was avoided in year one when the conversion had taken place, that will have to be paid in the year in which the conditions are not fulfilled. Now, we have discussed about what consists of turnover, gross sales, and gross receipts, because we've been considering about that in 4713B there is a specific condition that the turnover in the last preceding 3 years should be less than 60 lakhs. Now, the turnover gross receipts should be, there is a CBDT circular in that regard, that it should be whatever is taxable under the head profits and gains of business and profession. So if suppose any company is having two lands, and one land was sold for say 10 crores also, so since it is a capital gain in its hands, then it will not be counted in the turnover, because it would not be considered as profits and gains of business and profession, because it would be considered as if it has taken place under that capital gains. So one will have to consider only the turnover under the head profits and gains of business and profession, and not otherwise. Now, there is also certain queries which are raised whether MAT credit of the company can be utilized by the LLP post conversion. MAT credit cannot be utilized by the LLP. MAT credit, in case of mergers, there are decisions that it can be utilized, but in case of a conversion from a company into LLP, it cannot be utilized. One also has to consider whether it is necessary to remove the charge of the assets on the company prior to the conversion. Yes, the charge on the assets are required to be removed. Then whether the LLP has to renegotiate the existing contracts with the customers and the vendors, that is not required, because in the LLP Act itself, as part of the third schedule, it is clearly specified that the reference of the company shall be substituted with reference to the LLP. So on as is basis, once the conversion happens, the entire all whatever agreements were entered by the company, they will carry forward in case of an LLP as well. Now we discuss about the next thing, is of conversion of a firm into a company. We in the earlier slides we discussed about conversion of a company into LLP, the scenarios which can as a result of which one can think of converting a company into LLP. Now we would be discussing about conversion of a firm into a company. Now there are a lot of situations which happen when a firm has been working. Now they want to institutionalize the working, or they want to probably bring in more corporate governance, or they would want to take the advantage of a lower tax rate, because when we discussed earlier, in case of a firm, the tax rate firm, as well as in case of an LLP, the tax rate is 30%, but in case of a company, the tax rate is 22%. So if suppose a firm has been doing manufacturing activities, plowing back its profits, and now it wants to convert itself into a company, because it doesn't want to give much of dividend to its shareholders, want to claw back the entire profits into the company, maybe want to have some investor coming in, maybe want to have certain loans from financial institutions, then it might think of converting itself into a company. Now, in terms of implications, under the Income Tax Act of converting a firm into a company, again, as we discussed about Section 47(13)(b), in case of conversion of a firm into a company, is also is a tax neutral event if certain conditions are fulfilled. Now, what are those conditions? The conditions as were there in conversion from a company into LLP are similar, to some extent they are similar in case of a conversion from a firm into a company. Again, the first condition, that all the assets and liabilities of the firm before the conversion should become the assets and liabilities of the company. This condition needs to be fulfilled. Then all the partners of the firm immediately before the succession become shareholders of the company in the same proportion which the share capital stood in the books. Just one second. Sorry, there was some disturbance at my end. Now, we were discussing about the second condition, that all the partners of the firm should become the shareholders in the company in the same proportion in which their capital stood in the books of the firm. So there should not be any change in the profit sharing ratio or the partners' capital. Then the partners should not receive any consideration or benefit directly or indirectly in the form other than by way of allotment of shares. This similar condition was there in case of a when the company was being converted into LLP. The same sort of condition is available in case of conversion from a firm into a company. Then the last condition is that the aggregate of the shareholders of the partners at least 50% of the partners should remain the same and should continue as such for the 5 years post the conversion. So the partner should remain at least 50% of the partners should remain the same. Similarly, the depreciation, if we talk about depreciation, the depreciation is allowable, but depreciation in the case of a conversion from a firm into a company, till the time the asset is being used by the firm, the depreciation would be allowable in the firm, and thereafter, once the firm gets converted into a company, the depreciation would be allowable in the company. Now, similar sort of conditions in terms of the depreciation and accumulated losses being carried forward as is available in case of section 72A, when the conditions of a conversion from a company into LLP are fulfilled. The similar sort of conditions, if are fulfilled for section 4713, then section 72A would be in place, and whatever accumulated losses and unabsorbed depreciation are there in case of a firm, they would then be available in case of a company once it is converted. One important requirement in both the things is that 4713B conditions or 4713 conditions should be fulfilled. If it is not fulfilled, then there is no express provision under the Income Tax Act through which the accumulated losses on unabsorbed depreciation can be carried forward. Now, next we discuss about reconstitution of the partnership firm. Now, when we talk about reconstitution of the partnership firm, there is a newly introduced section 45, subsection 4, which was introduced in the Income Tax Act, Wide Finance Act 2021. At the same time, when section 45(4) was introduced, there was another section 9B was introduced, and we would be discussing in detail about both the sections. In section 45(4). Now, if we talk about first section 45(4), section 45(4) says that if it is applicable in case, and I will take you to the specific slide. I have discussed about the erstwhile section 45(4), the new section 45(4), the new section 9B. Just a minute. Section 45(4) was introduced in the was there earlier also, but it was revamped completely by Finance Act 2021. In the erstwhile section 45(4), what the section was that the profits, whenever there was a dissolution of a firm or a association of person. We would be restricting our discussion to the firm only, although the sections are applicable in case of association of person, body of individuals as well. But in case the profits were distributed to the retiring partners, and this is in case of retiring partners. So once they were distributed in case of retiring partners, then there was applicability of section 45(4), but there was applicability only in certain circumstances only. However, this has completely been revamped in terms of the new provisions of section 45(4) which have been introduced. And this simultaneously, as I mentioned, when 45(4) was introduced, simultaneously section 9B was also introduced into the Income Tax Act. And section 45(4) and section 9B are would be applicable simultaneously. It is not that once section 45(4) is there, section 9B would not be there. And we would be discussing this with an example. But let's first discuss about section 45(4). Section 45(4) says that where a specified person receives during a previous year any money or capital asset or both. Now, specified person means a partner. Now, whenever a partner receives during a particular previous year any money or any capital asset or both, so it is a very wide section that it requires whenever any partner is receiving any capital asset or any money from the partnership firm at the time of retirement or at the time of reconstitution, then the section 45 subsection 4 kicks in, and whatever amount is received by the partner over and above the amount of capital as appearing in the capital account, the additional amount is taxable in the hands of the partner. Now, there is a computational mechanism which is provided. It says that if a partner is receiving any money or capital asset or both, then it has to be in accordance with the following formula that the capital gain would arise. This is A is equal to B plus C minus D. A is what the capital gain is there chargeable as income of the firm. B is the value of money on the date of such receipt. So whatever amount is being received, this is the value. Then whatever if suppose capital asset is being received, then capital asset is to be added, and the value of money which is received, both the things have to be added, and less the balance in the capital account. So if suppose the balance in the capital account is say 100 rupees, and the partner in turn on his retirement or reconstitution getting 120 rupees, then this 20 rupees would be taxable in the hands of the partner as capital gains. Now, this in earlier scenario, it was not there. In earlier scenario, whenever there was increase in the capital balance of the partners on account of revaluation of the assets even, then there was no taxability. But in the subsequent, after the amendment, once there is a revaluation of the asset and the partner takes home a greater amount on account of revaluation, then this revaluation aspect has to be ignored, and the balance amount is to be chargeable to tax under the head capital gains. Now, simultaneously, we discuss about section 9B. Section 9B is tax. It comes into the picture when a capital asset or stock in trade is received by the partner. Section 45(4) is applicable when there is receipt of money or capital or both by the partner in reconstitution of the firm. However, in case of section 9B, it is only applicable when there is receipt of capital asset or stock in trade, or both by the partners. So if there is receipt of money additionally, then 45(4) would be applicable. If there is no receipt of money, then 45(4) would not be applicable, and section 9B would be applicable. Now, if we look at both the sections, section 45(4) and section 9B, there is one thing in common, that the capital asset is common in both. So if a partner on the retirement is receiving capital asset, then there is taxability both under section 45(4) and section 9B, because there is a lot of confusion that whether only one section can be applicable. No, the answer is no, both the sections can be made applicable, and we will discuss it with an example. I am skipping this. We will directly come to the example to understand how section 45(4) and section 9B would be applicable, and one will have to also consider the CBDT notification in this regard, and also rule 8AA and 8AB, which have been introduced into the income tax rules, and we will be discussing with this example. So with this example, everything would be clear. Now, this example is that there is a partnership firm, XYZ partnership firm, and it has three partners with equal profit sharing ratio and equal capital contribution. So suppose X has introduced a capital of 500 rupees, Y has introduced a capital of 500 rupees, and Z has introduced a capital of 500 rupees. Now, at the time of introduction, they had purchased a land, maybe 2-3 chunks of land, totaling to 1500 rupees. Now, in today's term, this 1500 rupees land, the fair market value is, say, 2100 rupees. Now, with this factual background, and now X from the firm is retiring, and his account is being settled by distribution of 1/3 land against his capital balance of 500 rupees. So there are, suppose, three lands in this particular, three chunks of land in this particular land of 1500, and each is of 500 rupees. The market value of the total land is, say, 2100 rupees, and Mr. X, when he is being retired from the firm, he is being given 1/3 land for his capital balance of 500 rupees. Now we will have to understand the implications under section 45(4) and section 9B when we look at this particular reconstitution. Now, if again we go to section 45(4), when will 45(4) be applicable? 45(4) is applicable when a specified person receives a capital asset from the specified entity, that is the partnership firm, in relation to reconstitution of the partnership firm. So reconstitution, if a partner is retiring, then it would be included in reconstitution, and section 45(4) would be applicable. Now 45(4) would be applicable. So one will have to, so this taxability under section 45(4) is in the hands of the partnership firm only, and it is not in the hands of the partner. One will have to consider this. Now, once we calculate the taxability, in terms of section 9B, 9B says that whatever assets are received by the partner, the fair market value of that asset should be considered as the sale consideration, and whatever is the cost of acquisition should be reduced, and the net amount should be taxable in the hands of the partnership firm, maybe under the head capital gains or under the head profits and gains of business and profession. Now, if it is under the head capital, if it is a capital asset which is being distributed to the partner, which in this particular case is, then it would be taxable under the head capital gains. If it would have been a stock and trade, we will be discussing about that, then it would be taxable under the head profits and gains of business and profession. then it would be taxable under the head profits and gains of business and profession. Now, if we talk about, because this is a capital asset which has been given by the partnership firm to the partner, Mr. X, so it will be taxable under the head capital gains, as well it will be taxable under the head under section 9B. Now, 9B says that the fair market value of the asset which is received, that has to be considered as the sale consideration minus the cost of the land. So fair market value in this example is 2100 and one third of the land is being given. So 700 rupees fair market value of the land is being given. The cost of acquisition is 500. The capital gain in the hands of the firm is 200. So this would be taxable under that capital gain in the hands of the firm. Now, with this, there would be one more taxability under section 45(4), because the partner would be getting on its capital balance of 500 would be getting 700 worth of asset. So there would be taxability in the hands of the partner as well. What would be the taxability? Taxability would be that 700 worth of land is being given to the partner. His capital contribution or capital balance is 500 rupees. So that would be reduced. Now, there is one more aspect which needs to be considered. One more aspect is that his capital balance, although is 500 rupees, but there is another there are two other lands which are also there in the partnership firm, and the increase in the value of that land to the extent of the share in X, to the extent of the share of Mr. X will also have to be considered. So for this, suppose the capital balance is 500 rupees, but the other land is of 1000 rupees, the remaining land, because the total land which was available was of 1500, out of which 500 rupees land has been given. So the available land is 1000 rupees. Out of this 1000 rupees, the market value of that land is 1400 rupees. So there is unrealized profit of 400 rupees. Now, Mr. X also has a say in that 400 rupees of profit, because 400 rupees profit is for the entire firm. So his share in that profit would be one third of 400 rupees, that is 134. So to this extent of 134 also he will have to pay, the firm will have to pay tax. So firm will have to pay taxes on two fronts. One is under section 9B of rupees 200, and the other is under section 45(4) on behalf of the partner of rupees 134. So this is because a lot of people say that this will result into double taxation. This is not double taxation. One is that the land is being sold by the partnership firm, or maybe transferred by the partnership firm to the partner. One, there would be tax liability on that, and the second is that the partnership firm, the partner would be getting certain profit, would be getting a higher amount out of his capital balance. So in that case, the balance amount would also be taxable in the hands of the firm. The taxability would then be in the hands of the firm only. So there would be two types of taxation under section 45(4) and the other under section 9B. Now we come to suppose we change the factual position a bit. If the factual position is that the land is now part of the stock in trade of the partnership firm. Now, in that case, there would not be any taxability under section 45(4), because 45(4), as we read, is only applicable in case when the capital asset or money is received by the partner. But the stock in trade is not a capital asset, so 45(4) would not be applicable. Only section 9B would be applicable, and under section 9B there would be a simple taxation that fair market value of the asset would be 700 minus the cost of land, that would be 500, and the balance of 200 rupees would be taxable as part of business and profession under the head partnership, under the head PGBP. That would be the only taxation which would be there in the hands of the firm. Had there been this 45(4) would not have taken place, then this amount would not have been taxable, because normally what the firms did was they revalued the capital balance, the land, and credited more amount into the capital account of the partners, and thereafter distributed profit. But now in this scenario, in the amended scenario of section 45(4), and with the introduction of section 9B, all these things are taxable. Now we come to conversion of certain securities. This is another important restructuring which takes place. There are different types of securities which can be issued by a company. We will put our focus to private limited unlisted companies only. Now, mostly companies today, apart from equity shares, they also issue preference shares, they issue debentures. In the preference shares, they issue compulsory convertible preference shares, means preference shares which can be converted into equity shares. They also issue debentures. So the debentures which can be converted into equity shares, because a lot of restructuring happens now, because in as per the relationship between the investor and the investee company, the instruments can be issued. For example, if suppose there is a new investor coming into the company, now this investor would want some security of the investment which it is making, so it would have some sort of say over and above the equity shares. So normally what companies do is companies issue convertible preference shares to those investors. There can be different mechanisms which can be put in place, also in terms of what ratio the conversion would take place. For example, if one equity per one CCPS, or convertible compulsory convertible preference share, is issued, so there can be terms and conditions which can be fixed, maybe at the start, that one convertible compulsory convertible preference shares would convert into say 10 equity shares. So or the conversion ratio can even be kept open and can be taken up at a later date. So all these conditions are quite flexible, because most of the sections which are there under the Companies Act also, especially in case of private limited companies, they are not applicable. So this can be more or less driven by whatever is written in the articles of the company. Lot of things can be written in the articles, and thereafter this restructuring can happen. So coming back to the types of security, so preference shares can be issued which can be converted into equity shares. There can be certain optionally convertible preference shares which can be issued, which may be optionally at the option of the investor can get converted into equity shares. There can be debentures which needs to be compulsory converted into equity shares. Loans can be converted into equity shares, and share warrants are also there. Now, the entire arrangement depends on a lot of factors. A lot of factors, maybe it can be based on some family arrangement, because one group might want to, there might be some split in the family. So these structures can be used. There can be rebalancing or restructuring within different entities in the same group. that can also be there. So these are all very flexible in terms of whatever is written. It can be specified in the articles of association. The conversion ratio can be kept open. There can be flexibility, the conversion in terms of the liquidity, when to convert into equity and when not to convert into equity. All these things can be very well defined. Now, as far as the Income Tax Act is concerned, under the Income Tax Act, there are two main sections which one needs to consider. One is Section 56 to Clause 7B, which would be applicable, and one is Section 56 to 10. Now, we would be discussing in greater detail both the sections. Section 56 to 7B. This is a section which is there under that income from other sources. Now, 56 to 7B says that whenever any shares are issued, now it talks about issuance of shares. Shares can be both equity shares and preference shares. So once preference shares are issued, then also 56 to 7B would be applicable. Now, whenever these shares are issued, so the issue price should not be greater than the market value of these shares. So, for example, if these shares are issued, say at a value of say 1,000 rupees, and the market value of those shares, and we would be discussing how to derive the market value. If the market value of those shares are say 800 rupees, then in that case the difference of 200 rupees, because the shares were issued at 1000 rupees, the market value of those shares were 800 rupees, the difference 200 rupees, if at all it is there, then it would be taxable under the under the head income from other sources in the hands of the investee company, in the hands of the company which is issuing shares under section 5627B. So one needs to, whenever shares are being issued, one needs to take into account the provisions of section 5627B, meaning thereby that the shares, if are issued, should not be issued more than the market value. It should be at the fair market value, or it should be only at the fair market value. If it is more than the fair market value, then it will entail addition under section 5627B in the hands of the issuer entity. Now, I have discussed about the fair market value. Now, one also needs to consider how to determine the fair market value. Fair market value is determined as per Rule 11 UA of the income tax rules. 11 UA prescribes specific scenarios wherein the valuation needs to be done. And if we talk about section 56 to 7B specifically, it prescribes methodology for valuation of shares, and that is prescribed under Rule 11 UA2. This Rule 11 UA2, in fact, has undergone a lot of change. And now there are multiple methods which have been prescribed, because in earlier, prior to this, and this amendment has come 2-3 months back only. Prior to this amendment in Rule 11 UA, there were mostly two methods which were prescribed. One was the discounted free cash flow method, or DCF method, as we refer to quite frequently, and one is the net asset value method. Now, after this, in today's scenario, after the amendment in Rule 11 UA2, there are multiple other methods which have been prescribed, because earlier there were only two clauses in Rule 11 UA2. Now there are other methods which have been prescribed, such as price matching method for venture capital undertaking, then specifically comparable company multiple method, probability weighted expected return method, option pricing model, milestone analysis model, replacement cost method. These are all the new age methods which are internationally accepted. These have been introduced under Rule 11 UA. Now, one important amendment which also needs to be considered under Rule 11, under 5627B, is that in prior to the amendment in 5627B, this 5627B was only applicable when the shares were issued to resident investors, meaning thereby that this requirement of issuing the shares at the fair market value was not applicable when the shares were issued to non-resident investors or non-resident shareholders. But now the amendment has taken place and now they have included both residents as well as non-resident shareholders. So if the shares are issued to even non-resident investors, then also 5627B has been made applicable. Now, as far as the methodology of valuation of shares is concerned, this table probably clarifies what method can be adopted in what scenario. So if suppose the shares are issued to resident only, then both are resident and non-resident. And if one wants to choose the net asset value method, then it is possible. DCM method, it is possible. Only difference is the new age internationally accepted methodology of valuation of shares, such as the comparable company multiple method, probability weighted expected return method, या option pricing model, milestone analysis method, replacement cost method. These are only applicable when the shares are issued to non-residents. These are not applicable when the shares are issued to residents. The main reason is that these types of methodology are internationally used, and the same way the Indian government wants to replicate it while the shares are being issued to non-residents. Then, so in case once the shares are being issued, one will have to, as I mentioned, one will have to look at section 5627B. As I mentioned in the start, that section 5627B is applicable on issuance of shares. So shares includes equity shares as well as preference shares. So if suppose a company is issuing equity shares, then one will have to consider section 5627B. If the company is issuing preference shares, then 5627B comes into play. Even compulsory convertible preference shares, which would subsequently get converted into equity shares, in that scenario also one will have to consider 5627B section. These days, normally companies also issue compulsory convertible debentures. Now, since compulsory convertible debentures at the time of their issuance are only debentures which are subsequently converted into equity shares, and as I mentioned that section 5627B is only applicable on issuance of equity shares, then in that case, if a company is issuing compulsory convertible debentures or CCDs, then there would not be any applicability of section 5627B. So that to this extent, one needs to be clear of section 5627B. Now, if we talk about conversion, what conversion entails is that a particular security, say preference shares, is subsequently converted into equity shares. Now, once it is converted into equity shares, then whether there would be tax incidence at the time of such conversion. The answer is specific to a specific scenario. If suppose a conversion, because preference shares can be converted into equity shares. So if a conversion is taking place between preference shares and they are converted into equity shares, it will not be considered as a transfer in the hands of the preference shareholders. So if tomorrow If suppose today I am having 100 preference shares and these get converted into equity shares and subsequently I get 1000 equity shares, then in that case it will not be a taxable event in my hand, because under section 47 there is a specific clause which says that if a preference share is converted into equity share, it will not be considered as a transfer. So as far as the shareholder is concerned, to this extent, it will not be considered as a transfer and there will not be any taxability under the head capital gains. But one will also have to look at section 56 to 10. Section 56 to 10 is a very important section whenever any restructuring transaction takes place. 56 to 10 says that if any asset is, if any security, and I will specifically talk about securities, if any security is received by any assessee below the market value, then the differential amount has to be added in the hands of the assessee. For example, if I suppose receive any particular security, suppose I receive equity share from Mr. A. Mr. A transfers equity shares to me and transfers equity shares, the market value of which is, fair market value of which is say 1000 rupees, and Mr. A transfers these equity shares to me at say 800 rupees. So I receive 800 rupees. 800 rupees, receive one equity share for 800 rupees, the market value of which is 1000 rupees. So this 200 rupees would be taxable in my hands. That is, I am the recipient. It would be taxable in my hands under section 56 to 10. Now, this is very, very important because this would be used in all the scenarios of conversion. So, if a company is converting its preference shares into equity shares, now one will have to look at from a recipient's or from a shareholder's point of view whether 56 to 10 would be applicable or not. Now, the answer is that 56 to 10, the legal position is that it is only when the new security is received. Now, one argument which takes place is that when the preference shares are converted into equity shares, the recipient of the shares, whosoever, suppose I was, just as I mentioned in the example, I was holding 100 preference shares which had the potential of getting converted into equity shares, and they got converted into equity shares, and in turn I got 1000 preference shares, equity shares. So in that case 56 to 10 would not be applicable because I am not receiving anything new. The preference shares were such that they were capable of being converted into equity shares. So there is no new asset or no new security which has been received by me. So in that case, one argument is that section 56 to 10 would not be applicable in case of conversion of preference shares into equity shares. As far as 56 to 7b is concerned, whenever there is conversion of preference shares into equity shares, then 56 to 7b would also not be applicable because the company is not issuing any new shares. Whatever shares were issued at the start, that is, at the start when preference shares were issued, they were issued considering that they would be converted into equity shares, so nothing new. So in case of conversion, one can safely conclude that or argue that there would not be any applicability of section 56 to 7b as well as section 56 to 10 in the hands of the shareholders. Now, there is one interesting point also in this, even preference shares, because there has been a few judgments that even preference shares can be converted into equity shares. Now, this same methodology or same ratio, what we discussed, can be made applicable to even conversion of equity shares into preference shares. equity shares into preference shares, even though, as we discussed in section 47, there is a clear-cut clause which is applicable in case of conversion of preference shares into equity shares, but there is no clear-cut clause which is applicable for conversion of equity shares into preference shares. So, however, even otherwise, my view is that even then, there would not be any tax liability in the hands of the shareholders, either under section 45 as capital gains, or under section 56 to 10. Also, there would not be any tax liability under section 56 to 7B for the company. Now, if we talk about conversion of CCD, compulsory convertible debentures, into equity shares, then also one will have to again look at section 56 to 7B. Now, as I mentioned, 56 to 7B is only applicable on issuance of shares, whether preference shares or equity shares. So, since debentures neither fall in any of the categories, then in that case, it would not be applicable. So, in case of issuance of compulsory convertible debentures, 56 to 7B would not be applicable. However, 56 to 10 would be applicable because on conversion, debentures would be given and preference shares or equity shares would be issued. So, one may take a stance that 56 to 10 might be applicable. Now we come to the last restructuring transaction which we would be discussing today is buyback of equity shares. Buyback of equity shares is also has become very important in last few years, because earlier what used to happen was whatever profits were to be distributed by, and we will specifically talk about private limited companies because mostly public limited or listed companies have been doing buyback, but private limited companies in the last 3 4 years have been doing buyback because of the reason that once the dividends were declared, in earlier scenario there was dividend distribution tax, so the taxability used to happen at the company level, and thereafter whatever dividends were distributed were taxable, were exempt in the hands of the shareholders. But now, with dividend distribution tax being abolished, the taxation of dividend has happened in the hands of the shareholders. Now, one may consider a scenario that the dividend, the taxability or the tax percentage of the shareholder is say 30 to 35%. So this increases the tax liability if one looks at the company and the shareholder or together. So people have now come up with different ways, and one such way is buyback of shares. Because when a company does buyback and buys back its shares and gives consideration to the shareholders, then there is taxability only at the rate of approximately 23%. 23% means 20% base rate, and this is provided under section 115 QA, plus 12% surcharge and 4% cess. So this comes to around 23%. So as against a tax rate of 34%, one can even recover, the company can distribute certain profits from its company at the rate of 23%. So this, for this purposes, buyback has also become very important. Next is buyback has also become very important whenever the company is wanting to restructure its capital, wherein suppose there are two groups of shareholders, shareholder group A and shareholder group B, and if suppose shareholder group A wants to exit, then one mechanism of doing that can be of buyback. So this, with this also, buyback in restructuring of capital has also been used by the companies these days. Now, what is the law which is governing the buyback? Buyback under the Companies Act is driven by Section 68 of the Companies Act. Now, Section 68 of the Companies Act says that buyback can be done by the company to the extent of 25% of the share capital and reserves in surplus. So there is a limit of 25%. More than that, no buyback can be done. Now, the also between two buybacks, there has to be a gap of at least 1 year. So one needs to consider that one, if a company is doing a buyback, then another buyback within a period of less than 1 year. It has to be for more than 1 year. Next is that the gap between the buyback and thereafter issuance of shares cannot be less than 6 months. So this is also very important. Buyback and fresh issue of shares 6 months to 1 year, depending upon certain scenarios. So and also one has to consider the debt to equity ratio. So these are all the conditions which are required to be fulfilled under Section 16. Now, as far as the income tax provisions are concerned, income tax provisions are quite clear in this. First, the taxability arises in the hands of the company. In the hands of the company, which is buying back the shares, the taxability is under Section 115 QA. And as I mentioned, the tax rate is 23.30%. 23 which is a cheaper rate in comparison to if the company would have distributed dividend, then the tax rate would have been around 34%, 30% plus education cess surcharge, so 34%. So against that, one can have a saving of around 10%. Now, other than that, for restructuring aspects, also buyback, as I mentioned, has been utilized by the companies, because one will have to look at the applicability of buyback on two, three sections which are important. One is Section 56 to 10, as I discussed in the previous restructuring concept, also of conversion of shares. In case of 56 to 10, as I mentioned, is applicable when a security is received by a particular assessee for less than the market value. For example, again, I'm repeating the example. If suppose I receive a share for say 800 rupees, the fair market value of which is 1000 rupees, then the differential figure which I have paid less of 200 rupees, that would be taxable in my hands. Now, however, if one look at the concept of buyback, now buyback is 56 to 10 would not be applicable, because in case of buyback, what happens is under the Companies Act, whenever any buyback takes place, then once the shares are bought back by the company, the shares are extinguished. So there have been case laws to this effect that 56 to 10 would not be applicable, because there is no shares which are received by the company. No shares which are received by, because courts have mentioned that when you look at the word receive means that the asset is received by you and the asset stays with you for long. However, in case of buyback, the company does not receive any shares. The shares, once the buyback happens, get extinguished. So, in a case of Vora Financial Securities, it was stated that 56, because this was in reference to 56 to 7, when 56 to 10 was not there, but still the ratio would still be applicable. So, in that case, it was stated that a 56 to 7A would not be applicable. The same ratio would be applicable for 56 to 10 scenario also. As a result, if in case a buyback is happening, a company is doing buyback, then one may take a view that it can do it at a lesser than the market value as well. Now, it can also be possible that a buyback can be done more than the market value, and Section 50 CA implication would not be there. One would recall that what is Section 50 CA? Section 50 CA is when the shares of an unlisted company are transferred to another shareholder. Then, similar to Section 50C, there is Section 50 CA. Now, Section 50 CA would also not be applicable because there is no transfer or any consideration accruing. Because in case of buyback, the shares, once the shares are taken back by the company, they extinguish. So it is actually not a transfer. So Section 50 CA, one may take a view, would not be applicable. So when Section 50 CA is not applicable in the hands of the shareholder, when Section 56 to 10 is not applicable in the hands of the company which is buying back the shares, then one may play around with the valuation aspect, but one needs to be very careful of the GAR implications also, because GAR provisions kick in if the tax benefit out of the entire transaction comes to more than 3 crore rupees. So even otherwise, if it is less than 3 crore rupees, then there can be implications under the Income Tax Act as well. So one will have to consider that. So buyback can be one good mechanism by which the company can distribute the excess capital to the shareholders. In this case, there would not be any transfer of the shares. Section 56 to 10 would not be applicable. Then, since Section 50 CA is not applicable, then Rule 11 UA would also not be applicable. In terms of the valuation, also one may be very free that Rule 11, because Rule 11 UA is applicable only in two scenarios. One is when shares are transferred under Section 50 CA. Rule 11 UA is applicable when the shares are issued. Then I mentioned that Section 56 to 7B is applicable, and the other scenario is when the shares are received by any assessee. Then 56 to 10 would be applicable. But since 56 to 7 B is not applicable in this case, 56 to 10, as I mentioned, was not applicable in the hands of the company, 50 CA is not applicable, then Rule 11 UA would not be applicable. So essentially, one may take a view that the shares can be bought back at a value higher or lower than the fair market value of the shares, but one will have to be very cautious of the GAR implications as well. And also, because if suppose the fair market value the shares are, say, rupees 800, and the company buys back the shares at, say, 1000. Now, company is paying 1000 for buying back the shares, the fair market value of which is 100. Now, since Section 50 CA is not applicable, there would not be any taxability over and above that in the hands of the shareholder. And since 56 to 7B is not applicable because it is applicable on issuance of shares, so there would not be any issue but there can be one allegation which can be made by the income tax department, is that instead of declaring dividend of, say, the balance of 200, what the company is doing is it is only buying back its shares, which the tax liability is lesser than declaration of dividend. So the GAR implications can be there. Now, if suppose on the other hand, if the shares are bought back at, say, 600, the fair market value of which is, say, 800, then in that case also there would not be any implication, because as I mentioned, 56 to 10 would not be applicable in the hands of the shareholder. In the hands of the company, because 56 to 10 talks about receipt of shares. receipt of security, but in case of buyback, as per the Companies Act, once the shares are bought back, they have to be extinguished. So that would also not be applicable. So there is a peculiar situation wherein Rule 11 UA would not be applicable because none of the sections which result into invoking of Rule 11 UA are not applicable. So one may take a view of realigning the shareholding, or say they are distributing excess funds to the shareholders through the buyback mechanism. Uh, However, as far as the GAR implications are concerned, if suppose a value higher than the market value is given, then the differential, there can be an allegation by the department that this differential amount is nothing but dividend which has been paid by the company in the garb of buying back the shares. So this one needs to take care. So essentially, if at all the buying back of shares is done at a value higher or lower, then there has to be a reason for doing such a restructuring, and this reason should be well documented amongst the shareholders and the company, so that in times to come, if at all there is any query which is raised by the income tax department, then one may even give this commercial backing of doing a particular transaction in a particular manner. So with this, I have covered the different scenarios which we discussed. In case any queries are there, you may reach out to me. The website of my firm is given, and the contact details are given, so one may reach out in case of any queries. There are other restructuring aspects as well of say merger of companies. Then slum sale is there, demerger is there, transfer by 100%, transfer of capital asset by 100% holding company to 100% subsidiary, and vice versa. But these are again, there are in-depth discussions which would be required. So I thought of restricting my discussion to these 5-6 scenarios which have been discussed by me. Thank you. Over to the educating team.
Sir, thank you so much for your wonderful discussion. And because I am not the student of income tax, so I could not understand too much. But the only things, the way you are explaining is really very good and very easy to understand. So that's a great. And in Monday, we will have some more discussion regarding this particular part regarding our platforms. Okay, so
Okay.
what would be the suitable time to call? You can tell me accordingly. I will call.
You can call me in the evening hours, sir. After 5, you can call me.
Fine. I'll message before calling. I'll message and then we'll have the discussion.
Sure.
Thank you very much for your
Okay, thank you.
time.
Thank you.
Okay.